All right, welcome to OK Computer. I am Dan Nathan. I am joined with Deirdre Bosa. She's the host of CNBC's Tech Check. Welcome back, Debo.
Always happy to be here. Whirlwind trip to see you in New York and Miami last week and back in the saddle.
Yes, you probably got a lot of intel. You spent some time in New York. You were on the public tech beat. You spent a little time in South Beach on the private tech beat here. We're going to cover all of those Q1 earnings that we saw last week since we were last with you. Also, some very interesting names that I know you're very focused on. You've been reporting all day here on Uber's results and their bang up results. And I want to kind of drill down on some of the metrics. You often push back at me and some other folks who are on your programming who refer to profitability, but in the terms of adjusted, and really feels like Uber is crossing a little bit of a Rubicon as it relates to GAAP profitability. So I want to hit that. We also have a great interview coming up. Dan Niles, the founder and portfolio manager of Satori Fund. Dan's a guy that I have known for an awful long time. D, I go all the way back when he was a tech analyst at Robertson Stevens in the late 90s covering semis and hardware. And he was like poster child for big tech analyst back in the day. And now he runs this fund that is a long, short, large cap, primarily tech focused fund. He's also a guy that you've had on Tech Check for years. Talk to me a little bit about Dan and your relationship with him.
Oh, let me first say that danniles.com is a legend. He is a wonderful person. Also, I should add, who we found out he was coming on Tech Check. And then one time we were going to do the CNBC Pro Talk and figured out that we lived a block away from each other. So that led to us and his wonderful wife and my husband playing cards sometime. If he's listening to this, I just want to say that if we had finished that last game, we would have beat him. And I'll leave it there. His market predictions and market analysis, much better than his card game.
Well, it's funny, he was literally, he was one of the first minted, .com era tech analysts. What I always found interesting about Dan is that, he wasn't covering the internet. He was covering the nuts and bolts of the internet when you think about semis and components. And then you think about his ability to also cover hardware as it related. He covered Apple and Dell, and he made some huge calls back in the day. And he moved stocks like you wouldn't believe. And he had a huge term because he went to Lehman and he was just a monster at Neuberger Berman. So I'm really psyched to reconnect with Dan. And thanks for the send off from Tech Check, because I've gotten to see him on your programming a lot over the last few years. And he is often prescient. He is ahead of the curve when it comes to tech trends.
And he's not afraid to disagree with the majority. And for as long as I've been interviewing him on Tech Check, he has been dead right. He takes short and long positions, but he watches things and he sees things so closely. And he's been truly one of the most rational voices that we've had, I think, on our air over the last few years.
No doubt about that. And he's also been really transparent. When he comes on and he gets something wrong, he's happy to come back and say why he got it wrong. But he's also, like you said, really willing and able to make predictions. All right, let's talk about Uber here, because this is one that we're recording this Tuesday afternoon. The stock's up 11% as we speak. They just reported their quarter. Dara Khosrowshahi, he's out there talking to the press, and he sounds fairly bullish. And some of the things that he's been saying about just consumer trends that they're seeing, it kind of flies in the face of some other things that we've seen. Dee, what's your take on this one? Because coming into the print, the stock has acted fairly well this year. Analysts universally love this stock. 42 buys. This is per FactSet, only 4 holds and 2 sells here. And to see a stock up 11% with that much support already from the sell side, it means that the buy side was a little bit behind this one. And so coming into the print here, they had set targets as it related to EBITDA profitability, as it related to free cash flow. They had hit those. Now Dara is saying they are going to be GAAP profitable this year. The market is taking that to heart.
Music to my ears. As you know, Dan, for a long time, I've pounded the table and said adjusted EBITDA is not real profitability. And I say that to investors, and I say that to Dara Khosrowshahi himself. We've had a lot of really good conversations about what markets are looking for, what Silicon Valley might be looking for. And I applaud his transparency. And he's been saying this for a long time. Even when he was talking about adjusted EBITDA, he reached that target sooner than, he had predicted. And instead of kind of basking in that, he's looking ahead to GAAP profitability. There was also a few lines in the earnings release about stock-based compensation, because I even took issue with their free cash flow. Yes, you achieved it, but look at how much of that is stock-based compensation. So I think that, slowly but surely, they're delivering. He is delivering. He is a Wall Street operator, and I think that that has been fine. And I wonder what your opinion is, Dan, because this is still a stock, even with the big, jump up today. It's trading at around 36 bucks and change. That is still almost $10 below its IPO price. So what do you look for in an investment? Do you want something that's profitable, or do you want something that's profitable and innovative? Is Uber both, or only one, or none?
Yeah, no, that's a great point. I mean, I think that their ability to kind of squash the competition as it relates to Lyft, and we know what's gone on there. I mean, Lyft is literally like a rounding error on them from a standpoint of revenue, but also from just market share. And then when you think of market cap, I mean, this thing literally has like a $3 billion enterprise value. Think about that. Right today, I mean, Uber has gained, $6 billion in enterprise value just on the ability to guide towards that gap profitability, which you have been all over, Debo. So I got to give you a lot of credit. One of the first times you came on here, I made the mistake of quoting a company that said was about to be profitable. You said, hold on a second, that adjusted profits. The other thing I'd say about Uber is that it appears that their margins have troughed a little bit. So this was a company that was doing 50% plus gross margins in the couple of years after they had IPO'd, and so I think that's also something that investors like to see. And then obviously what he had to say about delivery and Uber Eats, and when you just think of just how well they are doing in that department. I know that obviously it kept them a bit afloat during the pandemic when people weren't taking the rides, but their ability to kind of maintain share and kind of move towards further profitability there. I think that is part of this story and the global part of it. I know that a lot of investors, at least folks like me, and just talking about it a couple of years ago back on Fast Money, they really, I kind of said, well, Lyft, I really like this kind of domestic, singly focused on ride share here. And that's just been dead wrong. I mean, I've just been really wrong on that. The last thing I'll just say is that Lyft might start looking kind of interesting here just on the enterprise value and what we know, the data that they have as it relates to ride share, as some of these other big platform companies think about move towards like robo taxis and the like here, autonomous fleets. I mean, this could be kind of interesting. So just curious, like, does this cause you to like take another look at Lyft? Because we know that that quarter was disastrous. We know that there's new management in there. And it really feels like maybe this is just kind of so bad that it's good at some point.
Let me quickly go back to something you said. You said Uber beat Lyft. I think that Lyft killed Lyft. I think that Uber benefited because Lyft just took its eye off the ball, and you see this management change now. I interviewed the new CEO who was, still finding his feet. I don't know. I'm not really sure what to expect from him. We'll have to see. They're going to report soon. But he talked about pricing competitively with Uber, and again, it just goes back to this industry that is so asset light in a weird way, but so deeply unprofitable because of how the way that it counts its drivers and insurance costs and all those different things. So I think, Dan, were you saying that Lyft might be interesting as a target? Is that what you
Yeah,
were
it's like
implying?
as like a strategic target, just because again, we don't likely see a lot of this sort of M&A, strategic M&A, especially in this regulatory environment when like things are at their lows. But it just seems to me kind of interesting for a whole host of reasons when you talk about what Elon Musk has promised as far as robo taxis and the like. Here we know that some of the OEMs in Detroit have had interest in self-driving sort of issues. I know that Lyft had a partnership with Ford for a while. So like listen, sometimes when things are down and out, I tend to be a bit contrarian. And this one, to me, I feel like there's very little downside, especially with new management in there.
Have you seen the videos coming out of San Francisco? I think it's GM's Cruise. People are taking rides, totally driverless rides. And I think Lyft has an investment from them in the past. So that could be an interesting tie up, given, as you said, all the data that Lyft has. But remember, this is a company that's still controlled by its founders, even though there's a new CEO. I asked him directly, does anything about the dual class share structure change? Is that going to sunset? No. So how much can he really do? Are the founders willing to sell? They were able to step back. I don't know. Maybe.
You asked all the tough questions. That interview was on Fast Money, and I was loving it because I knew that you just had this opportunity. And listen, I give him a lot of credit. I mean, he just kind of stuck in, you kind of hung in there, and he took the questions here. Just going back to Uber really quickly. I mean, this thing, when I look at it bottoming out at some point, it has a lot of characteristics that we saw in Netflix and Meta last year. That it bottomed out well before the Nasdaq bottomed out in 2022, so mid last year. And so I think some of the things that Dara was saying to investors and the street was kind of resonating and about cost cuts and what he's saying now about headcount reduction and what they're seeing as far as with this like this expected consumer slowdown. To me, this remains like a sort of fluid situation. I look at the series of higher lows that the stock has put in over the last, call it 6 to 9 months, and it's definitely very constructive. And to see the reaction to what they had to say today, I think is pretty good. I'm not chasing the stock up 15% in a week, but this is one that I think I would look to buy on pullbacks because, if you look at that top line growth that they have, I think the multiple of earnings is looking pretty interesting to me, especially if we're going to see increased profitability.
Well, let me ask you something then. When you say that it's looking constructive, do you think that Uber could ultimately be worth more than $100 billion? Is this a tech company? Is it disruptive, or does it settle out somewhere below that as a utility? And a really good one for calling taxis.
Yeah, well, I look at just kind of like also on a multiple to sales at about 2 times here and look at some of these kind of mega cap tech stocks, which have not had a hard time growing, into like mid to high single digits multiples of sales, and then on the flip side of that, we have an NVIDIA that crossed $700 billion in market cap yesterday for the first time in a little more than a year, trading at 23 times sales. So I guess to your point is if the, service that they're providing is deemed to be a commodity, it will never grow into a mid single digit sort of multiple of sales. But if that profitability really starts to kick up and they're able to kind of grow their margins back towards 50%, this will easily be over $100 billion market cap company. So to me, I do find this a very unique story. And there's plenty of stories in mega cap tech that I do not find is interesting because of their ability to kind of maintain certain valuations at this interest rate environment. And especially as you're listening to this, the Fed is going to be coming out with their, kind of rate decision here. And listen, if we hear higher for longer, and you and I talked about this a little bit last week, I just think that this is the sort of thing that may cause some investors in a slower growth environment to rethink some of the multiples that we've seen off the lows from last year in some of these names.
One more question for you. Did you see the Wall Street Journal article about Dara Khosrowshahi driving Ubers under David Kay?
Yes. Yeah.
So
Pretty fascinating stuff.
it was okay. That's cool. But it was 5 years in, or whatever, how many years into his tenure as CEO. And I just want to say, because I don't think enough people know this, because they don't seek publicity for this, the Lyft co-founders drive every year for years since the inception of the company on New Year's Eve. And they don't ask a reporter to come along with it. They just do that because they want to know. And I think that that is something, like, they are innovators, but they lost the plot. But they have done things like that all along, which is why I think you liked Lyft at one point too. That focus, unfortunately, they kind of they didn't keep up in terms of running the company, the operations that Dara Khosrowshahi does have. But I just wanted to mention that.
Yeah, no, I like those guys. I like Logan and John. I think those guys are really great founders. And again, I like you gotta apply to any like listen, they were always number two and just became a more distant number two. They tried to hang in there and their ability to kind of hang it up a little bit. I'm sure they're supportive behind the scenes. So again, that Lyft is one that I just think look from a strategic standpoint could be very unique, not because the business is humming in any way, shape, or form, but because what they've built over the last 10 years, and even though being a very distant number two, I think there's probably strategic M&A in their future. All right, let's hit another one. This is a really interesting story. So as we're speaking right now, Chegg, okay, the online education company that was clearly a darling during the pandemic, right? Anything work from home, school from home, work out from home, order from home, whatever the hell it is, right? So this stock has absolutely gotten killed. It's down 40% today. They come out and they say that Chat GPT is destroying their business. And what's interesting to me about this thing, it's down 65% on the year. It's got $1 billion market cap. That's not why we're talking about it, because it's interesting. But when we think about some of these fintech models, we're definitely all the rage in 2020 and 2021. And the information had an article on a bunch of these, the upstarts and the Carvanas and some of these other buy now, pay later names. They were hyping their use of AI tools right back in the day to make better lending decisions. And that was just an embedded premium in those names. And people didn't give a shit what they were trading at multiples to anything back then. This is, a year and a half ago, maybe 2 years or so, and they've all come crashing down. So I think it's interesting on the flip side of this that you have companies now like Chegg blaming AI tools, right, for their demise here. And this one's kind of, and Dan Rosenzweig, who's the CEO of this company, he's been around a long time. He's a smart guy and he knows a lot about tech. How does this story kind of sit with you a little bit? Because it looks like, two sides of a coin.
But it's so illustrative of the threat and the opportunity of artificial intelligence, right? I mean, anyone you talk to anyone here in the Bay Area, they'll say, "Oh, we've been using it for decades already." But this is a unique moment. This is when it captures the consumer's imagination. It's like, sure, there were smartphones before the iPhone, but the iPhone changed absolutely everything about how we work and how we even conduct our lives. And that's essentially what generative AI is doing now. Yes, earlier forms that all the tech companies have already been using, the algorithms we see on Netflix, on Facebook, et cetera, that certainly changed it, but it was kind of a slow change that we didn't even really notice. It was like boiling in a pot. Now with ChatGPT and Bard, it's such a huge platform shift that it's amazing to me too, to see Chegg, but we're gonna find out that entire business models are going to be eviscerated by this platform shift and how quickly it's happening. And on the Chegg side, it's because their users are using Chat GPT to do their homework. They're no longer going to Chegg. And I really think this is just the start of it. And Chegg could be totally fine. Dan Rosenzweig says that they're going to use ChatGPT to battle ChatGPT, which is basically what anyone under threat from generative AI says. We're going to use it against. It's smart if you just harness it in the right way. We'll see, though. This is very, very early.
Yeah, no doubt. I mean, listen, it's kind of hard to see, and this kind of brings me back to about 20 years ago, kind of in the throes of the kind of post-dot-com bear market that we had. Is like some of these names that were so well loved, on their way to really zero. And when you see stocks down 90 some percent, and we're starting to see that more, I think a lot of investors are kind of new to the market. That's not something that they really have seen a whole heck of a lot. We've seen it in some of these regional banks that like felt pretty secure, right? And we've seen them go to zero. We've seen some of these fintech models that we talked about lose 90 some percent. And it's not just the little ones. When I think of, I'm looking at Square right now. Square is down, more than 7-8% on the year. That stock has lost 80 some percent from its all-time highs. I mean, there's a lot of names that are starting to flash from big gains in the first couple months of the year after getting destroyed in 2022 to now being down on the year. And that, to me, when I look at the NASDAQ, Debo, still up 15%. The NASDAQ 100, which we know the top 7 names make up 45% of the weight. But I'm seeing a lot of stocks, whether it be in cybersecurity, whether it be some of these kind of SaaS darlings, kind of go down on the year like a snowflake. This was one of the poster children, right, for this kind of pandemic sort of like rally that we had in big tech names. And this was a recent IPO, and it's run by a guy that everybody in the Valley just absolutely reveres, and it can't get out of its own way in 2023. So I think I see some kind of weakening under the hood, and I see a further concentration in some of the mega cap names here, which seems unhealthy to me right here.
It seems a little risky, right? Because if any of these names, like Apple still has to report this week, if it kind of blows its quarter, that has huge ramifications. But I also wonder, Dan, if on the flip side, maybe that's a healthy sign or an endorsement of this rally so far. Because if the NASDAQ's keeping its gains, but we were wondering a few months ago why all of these names were up with low profitability, the momentum stocks that reached, valuation highs during the pandemic. I also wonder, it was something I covered this week, was the ARM IPO and the J&J spinoff. I mean, also the fact that companies are testing out the IPO waters again, that could also be a healthy sign, right? You have new issuances.
Yeah, no doubt. I mean, listen, I will tell you this, though, that in an environment like this, you could see portfolio managers have to make room for some big names. And that doesn't always, it might bode well for the kind of new kid on the block, but it may not bode well for some of the stories that people just been hanging on to. So, again, it'll be interesting to see when that first IPO comes in 2023, a meaningful IPO here in the US, and how it's marketed, because we have not had a proper marketing process, right, since the start of the pandemic. And it will also be interesting to see how that process has changed a little bit. All right, we got to hit this one before we get out of here, before I get to Dan Niles here. Amazon reported Thursday after the close. The stock was trading north of 120. It was like 123. It was trading at the highest levels, I think, since September. Okay. And so it bottomed out somewhere about 81 in late December, early January. And then when they gave their Q2 guidance for AWS, the stock reversed, gave it all back. Here we are trading at about 103 or so. What was your takeaway way about that? Because we talked, you had this great preview on all the hyperscalers as we were talking about what Microsoft Cloud was going to do, what Google Cloud was going to do, what Amazon was going to do here. And when you think about their guidance for Q2, and you actually made a really great point that Amazon is very exposed to small and medium sort of businesses. So that Q2 guide really spooked tech investors. And I think, to your point about Apple, I mean, I think what we saw out of Microsoft, out of Meta, out of Google might have been as good as it gets for this kind of Q1 reporting period. So I'm just curious, did you think that was overdone, at least the pop to the upside and then the reversal and its inability to kind of get back on its horse?
I think that pop was on relief, right? We just wanted to get all of these big tech reports out of the way. And if they managed to hold somewhat steady, stabilize, that was good enough for the market. But we've talked about this, how critical cloud is to the whole Amazon ecosystem. It has been the profit engine. So when the CFO came on the call and said, we're expecting it to decline a further 5%, that brings AWS growth into right the low teens, and it's never been there. It was at 40%, I think, just last year or a year and a half ago. So that is also a reflection of that profit engine of Amazon, but also perhaps the enterprise spending, the economy at large, how other companies feel about the economy and their spending plans. Was it overblown? I might be willing to say yes. What do you think, Dan? Because Amazon is more than AWS at the same time. And there's another profit engine in advertising, which is proving to be more resilient. And even online sales are looking better.
Yeah, I know it's interesting, and you have that tough job. Your job is much tougher than mine at that 5:15, 5:20 mark as those results are coming out, and you have to parse through them live on TV, and you're asked for your take, and you have what is expected. We don't always know what the buy side is expecting, and we know that a lot of these stocks trade in the post market based on those sorts of expectations. I was looking at the quarter, I was looking at most of the metrics, and it looked pretty good, especially relative to what people were worried about, some of the macro trends in in Q1. And then when they gave the guidance, I mean, it seemed really clear to me. We were talking about it in the break. I was like, that's it. I looked at Melissa. I was like, that's it. We think we're going to look back in 2, 3, 4 months and say that was the canary in the coal mine. And, when you think about Microsoft and you think about Google and what they were able to do in cloud, I'm curious is like, they're clearly taking some share. They're also exposed to some different customer bases, as we just mentioned, and their businesses, their revenues are just kind of they're much more intertied now with all the cloud sort of stuff and the productivity tools and everything like that. So, they might have been masking some of the sort of weakness that Amazon was speaking to, or Amazon is probably trying to take them all down because they're taking share too. Curious your thoughts on that, because I know that this. Most investors are really focused on that number in AWS where that growth has decelerated meaningfully, right? From that 40 plus pound to somewhere in the teens that could look like low teens.
Low teens. I get on a media call right after the earnings break. I've got like five phones in my hand when a company like Amazon or Alphabet, one of the big tech companies, are reporting. And I got on the phone with the CFO, Brian Olsavsky, and this was before he said that AWS growth was going to decelerate further. And I asked him, what are you seeing in terms of competitive pressure wise? Is it the macro economy or is it competitive pressure, what you're seeing from the other hyperscalers? And he answered pretty directly. He said, it's the macro. But then he went on to say, later on the analyst call that AWS revenue growth would be down 500 basis points. So I didn't really buy it when he said that. And I thought it was interesting that they don't want to allow for that. Why would they? They're the number one position by far, of course, but Microsoft is coming for them. And I think there was a Morgan Stanley note that says, it's actually Microsoft could be the bigger player a few years from now. So that is a serious problem for Amazon. And also going back to our generative AI discussion, Microsoft putting ChatGPT and AI tools into a lot of what they do could give them the edge over Amazon that isn't talking a whole lot or nearly as much about those tools.
Yeah. All right. Last thing, just a little. You just mentioned, like IBM and some of these other like large cap tech names, old school tech names. Cisco was down a lot. It's been down about 15% since CDW pre-announced a pretty dire quarter, and they're going to report May 3rd before the opening. So CDW, that'll be interesting to see what they have to say on the guidance, because it really did take down Cisco and a whole host of other kind of some hardware names. They're a computer reseller, and they service businesses, government governments, a big geographic kind of footprint too. So that's something I'm focused on this week. Other than Apple. All right, Debo, we covered a lot of ground here. I really appreciate you being back here with us. So everybody stick around for my conversation with Dan Niles. He's the portfolio manager and founder of Sotori Funds.